Hi, I'm Lindsey Bell with Global Markets Intelligence at S&P Capital IQ. I'll be covering the market outlook for the U.S. and Europe. The declining trend in earnings estimates finally reversed course over the last 2 weeks as peak earnings season unfolded. Solid reports from the technology, materials, and healthcare sectors are helping to return fourth quarter growth to the levels that were expected at the start of December. Currently, the blended average growth rate stands at 6.7% on earnings per share of $30.26. Excluding energy sector earnings, which are expected to decline 23% in the quarter, growth would be 10.4% for the index. That's much closer to the 11.5% analysts were projecting at the start of the quarter. To date, only 40% of the energy sector has reported earnings results, but 71% of those that have reported have beat expectations. The refiners have been a standout with an average earnings surprise of 34%. That's impressive because estimates for this subsector were only reduced slightly during what was a bloodbath of energy earnings reductions between June and today. However, not all energy companies that reported results have reported good results. The operating environment for these companies still remains uncertain. Until oil prices can show either a stabilizing or steadily upward moving trend, estimates for 2015 are likely to continue to come down. Following that downward trend has been earnings for the S&P 500 in 2015. The current EPS estimate for the index is $119.88, well below the $132 that was expected at the start of the fourth quarter. Growth is anemic at 2.2% and continues to come down. Outside of the energy sector effect, a strong dollar is also negatively impacting corporate outlooks. The index is currently trading at 17 times next year's earnings, above historical averages. In Europe, estimates have been reduced for the Euro 350 index for both 2014 and 2015, though they remain quite high for 2015. Growth of 10.1% is expected next year, despite obviously weak economic data points coming out of the region and a reduction in growth expectations from the IMF and ECB. The only information analysts seem to be reacting to is a sharp reduction in oil and commodity prices. Energy and materials are the only sectors where estimates have been lowered since December 1st. Every other industry has actually seen earnings increase. Overall, we believe 2015 will be a year for active portfolio management versus passive management, which has worked in the past several years given the steady advances of the bull market. Until next time, I'm Lindsey Bell with S&P Capital IQ.